Hi there, it's Malcolm and Wayne, and today's subject is interest-only mortgages. So when I started off in the late 90s, I would say most mortgages were on interest-only basis. Typically then you would just pay the interest to the lender and look at paying the capital back at a later date, typically through an endowment policy or some other investment vehicle, and the end of the mortgage term would come to its end, your policy would mature, and you'd pay back the capital balance to the bank, and any surplus was yours to take as a cash-free sum. Didn't always work out like that, though, did it?
No, it didn't. Yeah, for many years it did, and you know, in fairness, a lot of people did quite well out of it for a long time. What you've got to remember is, in the early days of it, you used to have a tax relief called mortgage interest relief at source. So you were effectively paying less mortgage payments because you were getting some tax relief on your mortgage interest. So if you only paid interest only, that made it very cheap. And also, for a period of time in the early 80s and probably before my time, but you used to even get premium relief. So your endowment premiums used to be sort of get tax relief on those as well. So it was a really tax efficient way of doing it. And as you rightly say, the endowment policies would build up this lump sum of money. At the end of it, when you would need to pay your mortgage off, the lump sum matures, you pay off the remaining debt and keep what was
left into the sunset. Yeah, tax-free lump sum. But interest rates were really high at that period of time, so all investments were kind of yielding well, weren't they? And insurance companies on a low cost endowment would be making a projection at the outset of what the lumps would be. Now, as of course interest rates went down, we started to find a problem, and that the maturing values started to become insufficient to pay back the capital balances.
That was the problem. The projections just weren't becoming achievable, and what you needed those investments to earn, they just weren't earning. And so then, as you rightly say, then we hit a bit of a wall where all of a sudden these policies that you've been relying on to clear your mortgage weren't actually maturing for enough to clear your mortgage. And then we had the whole mis-selling scandals, you know, because people had believed that what they were investing in was guaranteed. Well, obviously it was never guaranteed, and there was a whole debate around what advice they'd been given and how correct that advice had been in the first place.
Probably the first of the mis-selling scandals.
I would say so. Yeah, I can't think of any sort of thing major before that. Certainly not in my working life, but. And you know, there was always two sides to the argument. Was it ever sold as guaranteed? You know, I'm sure a lot of the advisors were quite clear at the time that it wasn't. But certainly the regulators took the view that if there was any grey areas, you know, that maybe the advice hadn't been all that it could have been. So obviously since then, and we've been in a low interest rate and a low rate environment for a long time now. So those sort of things basically disappeared, and lenders, generally speaking, don't accept it on that basis anyway. When I say generally speaking, I'm not saying they won't accept interest-only mortgages, but the endowment mortgage per se has virtually disappeared. And
legacy lives on to this day, doesn't it? One of the first things that some people say is, I definitely want to repay a mortgage, even though a lot of this stuff is a long time ago.
Yeah.
Lenders reacted or overreacted at that time, because of course there are certain circumstances where interest only is a really sensible option, but it can be ever so difficult to obtain one. Now, should we talk about examples where interest only could be suitable? So things like, I had one recently where a customer was relocating for a job and he needed to run two homes, but he knew one of them was going to sell.
I think this is it. You know, if you've got, for example, you might have somebody who's say a landlord who's got other properties, and those other properties have got equity in them, or it may be that you are going to be in receipt of a trust fund or an inheritance, and an interest-only mortgage would be a great way of you being able to keep your commitments low. Now, clearly, you need to understand that your balance isn't going to go down. You are always going to owe that amount of money. But you don't, for a lot of people, they would look at that and think, well, I don't mind that, because I know that when that big chunk of money comes from my inheritance or from selling the other property or whatever, I know I can clear it, and in the meantime it means that I've not got big outgoings. So the difficulty is that over the years, lending criteria has largely moved away from that. I think because of the desire not to be seen to be mis-selling, and not so that no customer could be under any misapprehension that that their debt wasn't going down, they've become very cautious in terms of what they will allow.
So in order to qualify for a genuine interest-only residential mortgage, now, as we said, they're more than available on buy-to-lets, no problem.
Yeah.
Much more difficult to get on residential. Lenders put rules in place. For example, you've got to have a certain amount of equity so that you can prove you could downsize.
That's right. Some of the lenders I can think of one lender that actively will look at the average price of a typical property that you might want to downsize to make sure that you've got enough equity. Others don't do it quite as specifically as that, but some of them will say that unless you've got at least £200,000 worth of equity or at least £300,000 worth of equity, they won't do it. Others will say we will only do it up to a maximum of 50% loan to value. The other way that they sort of try to regulate this is by looking at the income of the applicant. So some of the lenders, unless you are on a very sizable income, which would rule a lot of, if you like, everyday customers out, but unless you're on that very large income, they won't consider you for an interest-only mortgage. I think the dinosaur in me a little bit thinks that some of these rules have become almost too draconian. The lenders do have, rules and regulations as laid down by the Financial Conduct Authority in terms of what they can and can't do. So I wouldn't want to castigate them too much, but I do think that that there are some people who, as you rightly say, for example, they might have a lot of equity in their house. They know that they're going to sell it. They know that they're going to downsize. And that would be okay for them, and they're quite happy to know that they're going to have that mortgage balance to pay off.
Well, they might
actually couldn't do it.
They might have children living with them that are in the 20s or whatever, and it's it suits them to have that kind of big house for now, but ultimately it's going to be too big for them kind of when they get older. And
they know that that equity will come back to them. They'll buy a smaller house, they'll bank the rest or whatever. So I think the thing about it is, on the residential side, it is much more difficult than it used to be. That doesn't mean it's impossible, and I think it's just a case of speak to your advisor, and your advisor will guide you as to what may or may not be possible.
I think from the lender's point of view as well, it has been a nightmare for them. This still haunts them to this day because we've got interest-only mortgages taken out 25 years ago that are coming to their end. The customers have ignored the letters or for some reason weren't able to switch onto a full repayment mortgage, and it becomes a real problem if they're not ready to do that downsize, or it's not possible to do that downsize. Then we're still seeing customers in a terrible sort of situation. So if that's you, if your interest-only mortgage is coming to an end, so you're more mature probably, and you've still got this money to repay, no way of repaying it, what would your options be?
Well, obvious one, you've got to sell it whether you like it or not, because ultimately the bank or the building society has got the right to have their money back at the end of your mortgage term. So you might be forced into selling it against your wishes. Depending on how old you are, there maybe would be the chance of remortgaging it, but the probability would be that you'd have to remortgage it onto a repayment basis now, and that might put real pressure on your ability to afford it. There are things like retirement interest-only mortgages that have started coming to the fore recently, or equity release type mortgages. So if you are getting to the older end of the spectrum, those sort of things might now become more of an opportunity that at least you can stay in your house and keep it on some form of interest only.
So there we go. Interest only, it was really mostly a thing of the 80s and 90s. The endowment scandal sort of came our way, and the shortfall started to occur, and latterly almost all customers on a residential mortgage go for a repayment capital and interest, so that the balance is coming down all of the time. But if you think an interest-only mortgage for some reason could be suitable for you, then do reach out to us for advice, and we'll let you know if there's a lender out there that will be able to offer you that mortgage. Thanks for watching. If you're in the market for mortgage advice, please drop me an email, malcolm@ukmoneyman.com, or give us a call, and please subscribe to our channel.